So I'm just going to do a little introduction, and then Peter, you can take it away.
All right.
For those of you who don't know me, my name is Emily Enger, and I'm a book marketing coach. And the way this particular conversation came about is I was doing a series in my group, kind of helping writers understand the money side of their business. And a lot of that has to do with taxes, which is so far beyond my expertise. Like I couldn't even begin to talk about that. And so I try to find experts to bring in every once in a while that can help authors with stuff that is beyond what I can do. And so I literally just searched the internet because I thought there's got to be somebody who knows taxes from the perspective of a writer. I've had my taxes done by several different accountants, both business and personal over the years. I've loved every single one of them, but they did not specialize for sure in writers. And so, of course, then I stumbled on Peter's book, which literally is called The New Tax Guide for Writers, Artists, Performers, and Creative People. And I thought, that's the person I need to talk to. That's the person we need to talk to. And when I first reached out to Peter, you were on like this European vacation. Like I was seeing posts. Was it Europe? I'm not even sure.
Italy, yeah, we were in Italy. Yeah.
I was seeing posts on Facebook of all this architecture and all the classic statues and just great art. And I was just getting more and more excited to get a chance to talk to you. So without further ado, I'm just going to let you take it over, Peter. And at the end, we can ask our questions. So Thank you so much. And if everybody could just make sure you're on mute while he's talking, and then at the end, we'll unmute individually. So.
Okay, so I sent Emily a handout, which is just kind of roughly what we're going to talk about tonight. Not that you need to follow along, but it may be for reference later on. This is kind of adapted from stuff that's on my website. So I've got an arts website that has a section for writers, performers, visual artists, and actors, like musicians and actors. And so there's a whole section in there which has a lot of this material is online. With checklists and deductions and that sort of stuff. But so writers are, vast majority of writers are what for tax purposes are called, are termed to be self-employed. And when you're self-employed, it basically means you're being compensated for work and you're not an employee. So you're not getting a W-2. And so for writers, that's of course royalties, and royalties are earned income for writers that belong on Schedule C as self-employment income. And towards the back, you'll see it. And most of you folks are probably familiar with a lot of this, so just bear with me while I do some just like basic stuff here. But a Schedule C is you've got a copy of that in your handout towards the back. But a Schedule C is a simple form that goes along with your 1040. You report your gross income and your expenses, which we're going to talk about what kind of expenses writers typically have. And it comes down to a net income. Now, for writers, their income from royalties for sales of books are subject to two levels of tax, which is very important to realize. So if I have a profit as a writer, if I always like to use little round numbers for my little brain, $100,000, you're going to pay federal income tax on that $100,000. You're also going to pay what is called self-employment tax, which is the tax that you pay into your Social Security account. So there's two levels of tax that this income is subject to for a writer. And the reason is because it's earned income. You're being compensated for having done something, written a book. And so it's earned income. So much like if you have a W-2 and you looked on your W-2, you see what are called the FICA taxes on the W-2 coming out. It's the same. Those taxes have to be paid when you're self-employed as well. When you're an employee, your employer pays half. The tax, by the way, is 15.3%. Your employer pays half, and then you pay half through withholding. When you're self-employed, you pay all the 15% yourself. And what it means is that this type of income gets taxed fairly heavily on the tax return, which is the reason why making sure you don't miss expenses is really critical. An expense, the IRS has, which I have here, the IRS has three criteria for an expense. It's got to be directly connected with your work. It must be ordinary and necessary and cannot be lavish or extravagant. I haven't come across any lavish or extravagant writers, but you have to, but this is an important concept because it means that you really have to be able to tie the expense directly with your work as a writer. And we'll talk about some examples of that soon. Income for a writer, of course, is commissions. Most writers, that comes through their agent, and they get a 1099 at the end of the year. But it can also be speaking fees. It can be, giving classes, et cetera, et cetera. Most of the time, you're going to get 1099 for your income. A 1099, a lot of you have seen those. 1099 is supposed to be issued by the payer if the payment is more than $600 in a calendar year. But for the IRS, of course, as you might guess, even if you have somebody that does not issue you a 1099, that income is supposed to be reported on your tax return regardless. But if you get a 1099, it's really got to be on the tax return or you're going to get a letter. Because IRS, one of the, as screwed up as they are, one thing they do always do right is take somebody's, look at Emily's tax return and they add up the 1099s and they look on her Schedule C and they say, wait a minute, she reported, $100,000 and the 1099s add up to 110. So we have a problem. You're going to get a letter about that. So that's most writers. I mean, I've got a lot of writers that have an employee, a job, a W-2 job, which they're a lot of times maybe they're teaching college or something like that, and then they have their side work as an independent writer. They're getting 1099s for publishers or agents, and that becomes the Schedule C. So their income, and I think the example tax return that I have that we'll look at briefly is one of those returns that has these both W-2 income and independent writing income. So let's go through some of the sort of common expenses. Travel and meals. We've had not much of that the last couple of years, but we're starting to have more. Travel is anytime you can document, overnight travel to somewhere that's directly related to your writing. It can be research. It could be, well, I'll give you an example. A writer that did a book about these people that chase tornadoes and stuff, storm chasers. She did research on storm chasers by going out to the Midwest and doing these tours that you could take with storm chasers and interviewing people. And so she was able to deduct all of that travel relative to going out to Oklahoma or wherever she went, I can't remember, and doing these tours. What was deductible for her? Everything was deductible from the moment she walked out of her apartment door till the moment that she walked back. It was all travel. It was parking. It was every meal. It was the cost of the tours. It was just everything she spent. I often say to people that everything is deductible in travel, in business travel, other than like buying gifts for people that you bring home. I mean, otherwise, everything is deductible in that circumstance. Now, for her, she had to be able to relate that trip to the book she had written. And in that case, she did get audited. That's why I always use that as an example. And we brought the book in with us, and she read the agent, which was pretty comical, but she read the agent passages that directly related to that travel that she had taken. The important part of that example that I want you to understand is that you really, I mean, I sometimes metaphorically think it's like a hook that I hang my coat on. You've really got to create that relationship. Have another writer that's a food writer and wrote a book on Italian food. And I, after talking to him, I felt comfortable saying that he could deduct a trip to Italy because he could document, I said, you got to document what you're doing every day, who you're going to see, what restaurant you're visiting, what chef you're talking to. In other words, you've really got to document this kind of stuff. But that's all about sort of tying these things together, this research, as opposed to, I'm writing a book about France, and I needed to go see the Eiffel Tower. I'm thinking from the example, but things that don't really seem to have a sort of intellectual connection. So if you're a writer that has some travel, now novelists, some novelists are involved if they're doing something that's historically related. I have a client that spent a lot of time in Russia interviewing Chechens for a book. So you can have stuff like that, but a lot of times novelists don't generate a lot of expenses, but you need to be able to make a cogent argument why that travel was necessary in the context of the book. One other thing I want to add, does it matter whether my book ever gets published or not? And the answer is absolutely not. It does not matter. I can bring in the book, my storm chaser never gets the book published, and she gets audited. She's written off all these expenses, and it doesn't change a thing in the audit because she wrote the book. She tried to get it published. It wasn't published, but it's still the research. Here's the book. Here's the research. Doesn't matter. Doesn't matter. Success never matters. So as long as you can show that you produce something, would we have needed to have some reject letters from publishers or agents? Yeah, probably. And here's the, I would have brought the manuscript with me and I would have said, here's the manuscript. She couldn't get it published. She's still working on rewrites and hoping to get it published. But here's the book. Here's the research, the travel related to that research. We're done. We're done. So keep that in mind as well, especially if you're working on projects that, that don't end up or get changed along the way or something like that. But, it would still be important to show the passages or the sections that you wrote that related specifically to that travel. So, I'm going into this mainly because travel, if I go to New York City to take a tax seminar, nobody's going to argue about that. That's simple. But for writers and people in the arts, a lot of times these things are, I don't know, they're a little squishier, and you want to be really conscious of what would be my justification for this trip. And your trip, by the way, doesn't have to be all business. I mean, it can be partly personal. You can take a trip and say, well, I spent 7 days in LA, and I worked on writing related stuff for 4 days, and 3 days was I visited my sister or whatever. I mean, that's fine, and you can take partial like that. But the other thing with travel is keeping like a diary is just a really fantastic idea. IRS just really has a real big thing about contemporaneous, that's the right word, documentation. In the old days, these things kind of going past the boards, but I always would have told people to grab business cards of people they talked to, some sort of documentation of where you did, or who you talked to, but a diary of saying, okay, day one in LA, I, went to see this agent, or I did this or that, so that you're showing this sort of ongoing activity during this trip. So that's, travel's not a hard thing to deduct. Again, I always find it very helpful. I hate it when people will call me and say, "Oh, I just went there. Can I write that off?" It's like, you just want to strangle us. You just call me first and let me walk you through this. And sometimes people will tell me about a trip, and I'll think, that's just, well, the way you've described it, it's more personal than business. We're not going to do that. Or, if you did this or that, then, maybe we could have written off half the trip or whatever. Meals. The hint I want to give you on meals is that if you do have overnight travel, so take my client that wrote the Storm Chaser book. If she was in Oklahoma for 12 days, she is able to use the GSA, the General Service Administration, there's a link on my website, publishes per diem rates for every city in the world. So if you're doing overnight travel, you can just look up what the per diem rate for meals is wherever you are, and you can just take that without keeping any receipts at all. The average rate in the States is, I think, $57 a day. Expensive cities are 71. I don't think that's changed this year. Expensive cities, LA, New York, Paris is like 180 some dollars a day. But anyway, these rates are published. So again, for travel, you need to keep receipts for hotels and airline, that kind of stuff. You need to have some documentation, but meals you don't. Now, most people are going to have probably two sort of types of meals. They'll have overnight travel meals that they're going to use per diem on, and then they might have local meals because they're going out with a colleague to discuss, agents, to discuss issues with a book or marketing or whatever you're talking about. Those meals are also deductible. They're actually 100% deductible for 21 and 22. And those, though you can't do this published per diem rate for those kind of meals, those are actual expenses. But in fact, under $75, you actually don't need a receipt. You just would need, I would just need to have an entry. Emily would write down, they went out with Peter and discussed depreciation or whatever. We spent $39. She would be able to take that as a deduction. For meals, the IRS wants to know sort of the who, what, where, when. But the most important thing about it is that business was discussed at some point in that meal. During that meal, we could discuss anything, but at some point she says, "Oh, what kind of retirement plan should I have?" or whatever question that you might have. But that's what a business meal is. So again, on here is kind of a write-up of this, but I think I've hit the sort of major areas. The next one I like to talk about. Any questions on travel? Does anybody want to think particular on that? So travel can be research. It could be going to see agents. It could be going someplace to interview somebody. So it can, it can be anything along those lines.
I have
Can
one
it be
real
Oh,
quick,
sorry.
Peter.
Yeah.
What is the percentage of the trip that has to be business versus personal before it can be counted as a business deduction?
It can be any percentage, if it's domestic travel. If it's overseas travel, it has to be a majority business if you're going to Europe. Auto expense, virtually everybody is going to take mileage for writing off their use of their car for business. And the rate this year is 58.5 cents a mile. It's by far, it gives you the biggest deduction 99% of the time, and it's easy. You don't have to keep odometer readings. Really, all you would have to be able to, all I've ever given the IRS is just a listing of, you know, where we drove and just an estimate of round trip mileage times the mileage rate. You know, I've never had the IRS really dig into that for most people. Most of the time, they don't even ask about it. So the way to write off the use of your car is definitely using per diem mileage. And that covers, that's all inclusive for the car. That's owning the car, that's gas, that's you know, repairs, insurance, that's just all inclusive. Actually, that rate actually is going up, and actually I think went up on July 1st. I forget what that, they increased it this year for obvious reasons. But per diem is always the way to go. I've got an explanation in here of the alternate way, but I can't even fathom when a writer would be ever doing anything other than just straight mileage deduction. It's so easy. Yes, did you have a question?
I did. So would going to a conference, a writers conference, classify as something?
Oh, yeah, absolutely. Yeah, absolutely. Okay. Yeah, a retreat, anything like that. And you would just, again, want to make sure you have the documentation that, you know, whether it was the brochure on the conference or whatever, just so that you had some sort of documentation. I mean, you got to keep in mind, and I'll talk about this a little bit more later. I don't want to get bogged down in it, but you know, the IRS, you know, at least it's been that you have to hand them some piece of paper. I mean, you have to prove that, yes, I went to this conference. I wasn't a writer, but I said to she was traveling to Toronto for something. I forget what the hell it was. And the agent actually said to me, well, how do I know she doesn't have a boyfriend up there? So that's the kind of mentality you bump into at times. The next thing I wanted to touch on was equipment, which for writers is going to tend to be technology, you know, computers or iPads and that sort of stuff. The purchase of a computer or a new iPad or smartphone or whatever, you know, readers, a Kindle, etc. Theoretically, those are assets that have to be written off over time. So a computer under IRS regulations is 5-year property. So, you know, if I buy a computer for $1,000, doesn't exactly work like this, but it's sort of like I'm parsing that out and I'm going to take a $200 deduction each year for 5 years until I write it off. But the IRS has mechanisms, 2 of them, that allow you to write off a computer in a single year. But what I wanted to mention is that one of the common mistakes I've seen through the years is that people will lump that stuff like into office supplies or something like that. And you just want to be aware when you buy a piece of equipment that it's intrinsically, it's different than anything else. If I pay my cell phone bill, that's a 1 month expenditure for that month. If I buy a new, you know, computer, the IRS is saying, well, that is a you know, today I bought a computer for $2,000. I'm going to have that computer for a period of time. So it's going to provide the business benefit as far as the IRS is concerned over 5 years. And that's why they require it to be dealt with in a different fashion. So just keep that in mind when you're buying any piece of equipment, say more than, you wouldn't do a Kindle, for instance. That was a bad example, but you do. I would treat an iPad like that. I would treat a new, Samsung Galaxy or iPhone like that, because those are expensive enough that if they get lumped in with other things, it would be handled incorrectly and be an issue if you were audited. The other specific subject I like to touch on is the home office. I can't imagine I've got a single writer that we don't do a home office for. I can't imagine any writer that wouldn't be doing a home office. A home office means that you've sort of earmarked a room in your house. That looks like one right there that you have as a office. And when the advantage of it is that you're allowed to take expenses relative to your living space and apply a percentage of them as a direct business deduction. The home office form is and I think I have an example of it in here, but the home office form asks you to give the square space of your office, your dedicated space for work, versus the entire space of the entire living unit. One thing I want you to know about that is when the IRS is asking for total square footage, which is what the form asks for, they're not talking about the real estate agent's version of your house, which includes the attic and the garage and every other freaking thing that they can include. What the IRS is asking for is they're asking, again, using simple example for me, I've got 4 rooms in my house. They're all exactly the same size, and one of them is my home office. I'm using 25% of my home for business. You're not counting hallways, bathrooms, really unused parts of your house. What they're trying to get at is that these, the square footage of the usable rooms of my house, bedroom, dining room, kitchen, living room, what is the square foot of those units versus my dedicated office, right? That's what that percentage is. Once you get that percentage, and I will tell you that probably the most common is between 10, 15%, but I've had them as high as 80, and I've had some lower, then you get to take that percentage. So in the example I think that I have here, it's 20% of the house. I get to take 20% of all the expenses of that house: rent, mortgage interest, property taxes, homeowners insurance, utilities, repairs, everything. The way you want to think about your home office is that everything inside that office is 100%. Bookshelves, art on the wall, desk, all technology, etc. Anything inside the room is 100%. What the home office is doing is saying, well, in the entire house, I need to, this room is 20% of the entire house. I've got everything is deductible that's in that room. I've got to get the 20% of everything else that's connected with this house. And that's what the home office does. And of course, when you're grabbing that 20%, 15, whatever the percentage is of those home expenses against your writing income, then you're offsetting income tax, you're offsetting the 15.3% self-employment tax, etc. So it doesn't tend to be a large deduction in size, but it's a really good deduction. And if you're a writer and you're working from home, you got a home office. I mean, unless you're really like living in 1 or 2 rooms and you're working at your kitchen table, I guess. But I don't think I've got a single writer, probably a single person in the arts that's not doing a home office. It's just virtually always just I always do it. It's not. I don't know if people still think this, but for years I would hear people say, "Oh, you know, my Uncle Joe said it was an audit target." If the IRS were auditing home offices, they wouldn't be auditing anything else because they're so common now. So I don't see. I can't imagine any reason somebody wouldn't take one. You also have in here a little bit more of a write-up on the self-employment tax that I touched on at the beginning, and the fact that your writing income is going to be subject to income tax, federal and state, and that self-employment tax that you're paying into your own Social Security account. I'd like to mention that because I've had people that I filed for years. If the subject never came up, they'll all of a sudden call me or email me and say, "Oh, you know, somebody told me I should be paying into Social Security." And it's like, well, you have been paying into Social Security for years. That's why you pay so much in taxes every year. You know, for people that make, say, 50, 75,000 of self-employment income, their tax bill is going to be higher for the self-employment tax than it is for federal income tax. And it's only around 60, 70,000 that starts to diverge, and you start to end up paying more. It's probably higher than that, actually. Start to pay more in federal income tax than you are into your own Social Security account. Any questions on any of that?
Yeah, I've got a couple. So my home office, I'll even move out of the way so you can see the bed on the floor. It's not just an office, it's a spare bedroom, it's a storage place. I use it to store even stuff for a different business that's not my writing that my husband and I have, but there's also personal storage. Is this really, can I count this as a home office?
Yeah, well, I would tell you though. So home offices, don't cause audits, but if you have a home office, at least this has been my experience. I don't know if this is going to change, but if I have somebody audited that has a home office, they're going to have to address the home office. Now, what does that mean? It means that the IRS is going to ask for for you to sketch out your house, just like a footprint. You know, here's the kitchen, here's this, here's my home office, so that they can gauge whether the percentage you've taken is correct. I've never seen them ask for like square footage. I think they just want like a visual. The second thing they will I think virtually 100% of the time are going to ask for is pictures. Now, I would tell you, you got to get that bed out of there before you take the picture. So would I take the home office personally? I absolutely would, because it makes sense. But the bed would be an issue. Yeah.
It's technically a Murphy bed. You can't really tell. So it
Oh,
does fold up on the wall. So if I just fold it up, is that good?
absolutely fine. Yeah, yeah. It's just the IRS rules are that it's a dedicated space. One of my writers was audited once, and in the middle of her office was her treadmill. And I said, she sent me the picture. She said, "Well, I got a treadmill." And I said, "Well, that's fine." I said, "Do you have a book mount in the front of the treadmill?" She said, "Yeah, of course." I said, put a book in the mount before you take the picture." I said, "We're fine." And there was nothing ever said about it. So, you know, I think they're looking for really obvious, but yeah, you would just fold that bed up, you're fine. It's not the fact that it's there is not a problem in and of itself. It's just that having it be, yeah. Same thing. People say, "Well, I got a couch in my home office." Oh, that's fine. Yeah. So, yeah. Yeah, did you have something else, Emily? Okay, all right. Um, so let's go through. I've got this sheet. It's online. It's expenses. And you're welcome to ask a question, but expenses for writers. Again, we've talked about travel if you're doing a kind of writing that involves research, but certainly any professional organizations or associations that you are involved in, books that you buy for research, whether electronic or physical books, any course, any educational types of stuff that you're paying for, obviously paying for perhaps for marketing, that sort of stuff. Office supplies, obviously. If you took a course at a local college or something like that, anything online is fine. Keep in mind for online, you're certainly, all writers are deducting at least a percentage of their home internet. People were buying, new cameras for Zoom and stuff during the pandemic. All that stuff would be deductible. Some expenses, especially when you're self-employed, are not going to be 100%. I mean, a lot of expenses that you're taking, car is a great example. Maybe I drive my car 10,000 miles and I'm deducting, 2,000 miles for business. Home internet. There's no way to document the amount of time I'm using my home internet for business. It's impossible. I just tell people, what do you feel comfortable? Home cell phone use, same thing. What do you feel comfortable taking? Well, we'll take 30%. That's fine. You're never going to have any arguments with that. Cell phones, what I found in cell phones when the IRS and the audits I've had recently is they just look to see a single invoice to see how many people are in the plan. And so if it's a family of 4, they're going to allow me to take 25%, my percentage for my business. And I've never seen them even argue about that. So that kind of stuff, nobody really pays a lot of attention to, as long as people aren't, as long as it feels reasonable. So there's a lot of things like that on the return that you're taking some percentage. There's no way to document. I just tell people, what do you feel comfortable with? If it's 2 people and there's no kids in the house, you say, hey, listen, most of the time I'm on, it's business, I want to take half. I mean, it's fine. Travel we've talked about, and mileage would be something you could document for a business purpose. Apps on your mobile devices, any software services, Dropbox, all of that kind of stuff is all deductible. Anything that you're buying for research, if you're the client's not a writer, he just made a documentary film, so he was watching every documentary film for every streaming service, everything that everybody had. So, this year I'll take probably a decent percentage of all of his streaming services based on the research he did for this specific film. But you could have the same thing for a book. If you were working on a screenplay or you were writing something you felt was going to be a natural for, to get an option, you might be looking at some movies. I've never had any of that kind of stuff audited, but my feeling is that you would need to be able to document how it's specifically related to what you were doing. Again, this idea of making this connection between your work and this expense. And lastly, again, that you're always doing something reasonable. You're not writing off 100% of every streaming service. Well, that makes sense. That's basically telling the IRS, I never once watched a single thing just for the pleasure of watching. It just doesn't make any sense. So you're always grabbing, part of what you're trying to do is grab a percentage of everything you can, really, to try to get the best tax result. You know, obviously legal and professional services, if you pay to get your taxes done, that sort of stuff. Obviously, all office supplies, postage, shipping, any of those kind of services. Again, home internet and home cell phone, you're always going to be taking a percentage of that. You know, any technology purchases, that sort of stuff. So it's the other expense I'll mention here, which I should have here. This is, I think, the number one most common mistake I see on people's tax returns. They get a 1099 from their agent. The 1099 from your agent is gross. It's supposed to be gross. It does not include the 15% commission. And that is the number one mistake. And it can be a really huge mistake. So if you've gotten royalties for a book for $100,000, that's going to, and you get a 1099 for 100,000, that's the gross number. That doesn't include the 15% the agent took, and it doesn't include any of the little ancillary charges that agents will be charging, you know, phone calls and foreign taxes and bank fees and other, which don't usually amount to a lot, can, but usually don't. If you're working with an agent, always get a year-end summary from the agent. You cannot rely on the 1099 because, again, it isn't all. Sometimes they do issue them net. I have a very famous writer who's the agent just issues everything net, but I've not seen that. You are seeing less and less of that. So that's why when I see the 1099, I always ask the client to get a copy of the accounting summary from the agent for the year to make sure I've got all the expenses. So yeah, so this list is a pretty good one. I can't believe I've still got fax machines on this, but anyway. But this is a good list to give you an idea of what kind of expenses you have. My novelists just virtually have almost nothing because novelists are sitting at home writing, unless they're doing some research for something. I've got some extremely successful novelists, and other than commissions, if the expenses come to $100, it's a lot. So, but that's the way it is. This is from my book, but this is sort of an example tax return. I think it's helpful insofar as you may get a sense of what your tax return should look like when it's done. So in this case, this person does get a W-2, and then there's a Schedule C that we're filling out for writing income, and there's examples of the kind of expenses that we've taken. This is actually a real return, but obviously the person's made up. But you know, I have expenses for every writer. I have has an expense category that I call research, which is again buying books, and so I think most novelists could write off probably every book they buy in a given year as research. There was not too long ago a Supreme Court case on whether somebody in the arts, in this case it was a musician, but could somebody in the arts claim a deduction for expenses related not specifically with what they did, but related to keeping up with the environment, their work environment in the arts that they're involved in. So in other words, can a musician write off a ticket to go see a show, not because seeing that show relates to anything they're specifically going to play or work on, but they're just seeing what else is going on and what's happening in performance space now. So it would be the same argument with writers reading other novels to just understand what's, what kind of stuff is on the bestseller list or etc. So I think most writers can write off, probably most of the books they buy. Again, electronic or actual books. Travel. I went to a book launch last night, so I can deduct the mileage going in there and whatnot. So you really want to think about sort of everything you're doing that relates to your writing. I mean, that's how you want to think about it. I think sometimes people just think, well, I'm writing this book on the writer last night, that part of the book takes place in Sicily. So he was talking about traveling over there, but he's got those expenses specifically maybe related to that travel and that specifically relate to part of the book, like my storm chaser. But you're also in a business, so anything related to just the general being in the business of being a writer. So I think sometimes people tend to want to narrow it down and it's just this, I'm working on this one thing and it's just related to this one thing. No, it's your life. And the thing I found out about people in the arts, which I knew before, but that you guys are believing this stuff all the time. I mean, it's just with you all the time because that's the way it is. It isn't like somebody went and punched in and punched out. I mean, it's not that. So you really have to think about this craft that you're in and how many parts of your life that it's touching and what expenses you might have related to that within your day-to-day life. The last thing I want to mention, just because I think people don't ever hear about this, and maybe we're going to start seeing more of these IRS audits. IRS audits are caused by specific things on the return. They're not, sometimes they can be caused because a particular part of the IRS might be looking at particular types of businesses or people, workers, or whatever. But they're generally chosen because some expense line seems extraordinarily statistically high. But an in-person IRS audit, if they point to an expense, so let me take my tax return here and let me do travel. They are going to want to see two things. So let's say my travel, let's just say it's one trip to I think the example on this return was Ireland, I don't remember. But anyway, let's say it's a business trip to Ireland. And I've got the documentation for why I was there, etc. The IRS is going to want to see the original receipt and proof of payment for that entire amount. And it's the same thing for anything else they happen to look at. They're going to want to see the original receipt that backs up the purchase, and they're going to want to see the credit card or debit card that I used to pay for that receipt. So that should tell you that audits are a real pain in the ass and very time consuming if you have a full-blown one. So keep that in mind, that you do want to keep those original receipts. If it's something you're buying online, it's an email. I tend to print them out, but you want to be sure you keep that printed receipt. And that if you're a lot of times I'll tell people if they're using their credit cards a fair amount, that maybe earmark one credit card to sort of be the business credit card. It doesn't matter what it says on it, but just so you say, okay, for me, it's my Capital One card. That's anything on that, I'm going to probably deduct. And if it's personal, it'll be the other card. So just to make it so it's a little more controlled, so that if I was audited, I might say, well, everything that's charged is going to be in these 12 monthly statements, be able to see what the, see the charge. But the credit card statement is not going to be a justification of the expense. That's where you need something along the lines of a receipt. The IRS has not been doing virtually any auditing the past few years, but I'm sure you've read that Biden's setting the dogs loose. So Janet Yellen says that she's telling the IRS not to audit anybody under $400,000. That is absolutely not going to happen, because they'll have to get into smaller businesses and whatnot. So they will end up certainly doing more than that. But I think they'll probably stay away from sort of normal taxpayers. But Schedule C's, the form that we're talking about that riders file, is a popular form for IRS to look at. Probably most of the audits I've had over 30 years have probably all been Schedule C's. So it's a very common form, and they'll be doing them. So just try to keep. I tell people that you don't need to be neat in keeping receipts. I always tell people you just want to feel like, well, if I had a gun to my head, I could find it. It's here somewhere, wherever. But you don't have to win any awards, because always the likelihood is that you're never going to get audited. But it does happen, and so you want to be ready. I think that's about all I've got. So any questions anybody has, I'm more than happy to answer.
Oh, this is awesome, Peter. Thank you so much for all of this information. Can we talk a little bit about, for those who already work with an accountant, but like in my case, I worked with a couple different tax preparers. None of them have had any experience in the arts. What do you see as somebody who specializes in the arts that maybe your colleagues miss sometimes about what a writing business includes, that we should kind of advocate for ourselves to our accountants?
Well, I think probably using the kind of checklist that I have online. Accountants love friggin' checklists. So I would say that using, because these things that I have in the packet, you can download these in Excel and fill them out. I think filling them out is it would probably be a great start to have everything organized. You want to at least have. I mean, when I started doing people in the arts years ago, the thing I would hear over and over again was that they went to an accountant that just didn't understand that a writing was like even a business. And so you can't have an idiot like that. That's insane. So you at least have to, even if they're not experienced, at least somebody that's got some sensitivity to what's involved. But I mean, I think that one about the agents commissions is a real, I mean, I've seen that on some really famous tax returns. It's just like, what the fuck are you doing? The other common one, and I had this, I could tell you of a very famous writer that the guy did this to. Writers get a form that says royalties on it, right? That's what it's called. In the tax world, there's two types of royalties. One is the royalties that a writer gets. The other royalty is oil and gas. Like I own a percentage of an oil well. This is a common one too, actually. Own a percentage of like an oil well. I have seen I have seen returns where the royalties, the 1099 for royalties, was reported the way you would report oil and gas royalties rather than writers' royalties, which means that they did not even have a concept of what writer's income even is. I mean, how do you make a mistake like that? That's like I've got a window here. Let me put bricks in it. It's insane. It's insane. It's like, what the hell are you doing? That you don't understand that this isn't, that a writer's royalties for producing a book are not the same as investing in an oil well. You know, that's a common one. I've seen that many times. For this very famous writer, the guy had reported them that way. The way he'd done it, he had missed a huge deduction, and there's a write-up on my website about that. The one that Trump put in called the 199A deduction. And this writer, I mean, when I amended the return, she's getting back around 15,000, but it really probably should have been more than that. But yeah, so it's just interesting mistakes like that. I guess those are the kind of the two things I would think about. But a lot of it is just how you're produced. A writer's income is always going to be on a Schedule C unless they choose to set up a corporation. Let me touch on that very briefly. When does a writer set up a corporation? Probably when gross royalties are getting in the neighborhood of $200,000. So when people get into that, or they're getting into some big advances, there's there's actually an article on the website about it. I won't go into it, but there are strong advantages to becoming an S corporation at that point, and most of my writers are in S corporations now. But you would never do that unless you were probably in 150 and up before you'd even start thinking about it. And the reason is that the extra expenses of the corporation, you don't save enough money to even pay the extra expenses of the corporation. But the more money you make, the more that starts to break, and you have can have some really substantial tax savings.
So based on what you've presented tonight, basically I'm seeing that the key to managing your taxes as a writer is just record keeping, right?
I think so. Yeah, because I mean, I always feel like the best thing I can do is instruct people what's deductible and what to keep track of through the year. Mm-hmm. So that when they come in, they know that, I had 2 book events that I bought, wine and cheese for. Well, that would all be deductible. Or people that I had a client that had entertainment once at a book launch and was able to pay the guitar player for playing at the book launch. So just, anything, it's really anything related to your writing is potentially deductible. I mean, I tell people, bring me everything. If something looks stupid, I'll throw it out. I mean, but I don't know that that's ever happened.
Do you have any tips on, are there technology or organizational hacks for those of us who are not good at that piece to just keep us on track a little bit better?
Well, I mean, you could use a program like Quicken or something like that. But I mean, honestly, if you do a good job of keeping your receipts, I mean, part of me thinks that sitting down in January and taking a day and putting them into piles and adding them up, I mean, that works too. But I have a really simple Excel spreadsheet that you can put the numbers in columns that will add up and add it up at the end of the day. I mean, for a lot of writers, what they're doing is not voluminous enough to require like really, day-to-day record keeping, sort of like shooting a fly with a bazooka. So I think you're trying to keep your record keeping you know, in some kind of harmony with what you, you know, with how much of it that you have. But I think keeping, you know, I mean, behind me, I've got, you know, had this for 100 years or wherever the hell it is. But anyway, I've got a drawer with folders, office supplies, subscriptions, education, postage, and you know, as receipts come in, I just throw them in there. Now I'm tracking all that stuff. I never look at them, but at least I know that they're there. So I think I guess the main piece of advice that I would have is that do whatever you need to do to make sure you don't forget anything. Just make sure you're getting everything. I have one of my writers that highlights or tries to do everything on her credit card and just goes through and highlights the credit card. Oh, these are all business expenses. You know, well, you know, that works. So, but I think the real thing is I always worry about is what am I not getting? And I can look at a return at times and think, yeah, no, you know, travel's $5,000 and meals are 49. No freaking way you spent $4,900 traveling and you spent $40 on meals. So I would say to that writer, tell me where you traveled to. Oh, I was in here, these 3 places, and I'm 4 days here, 5 days or whatever. And you just do per diem, and you probably will come to, you know, $1,400 or $1,500, and now you got a halfway decent deduction. So some things kind of jump out at you. The one I mentioned at the beginning about people lumping in like equipment purchases with office supplies. You give me your office supply and it's $5,000. Well, there's something in there because you didn't spend $5,000 at Staples on miscellaneous office supplies. So I know that there's probably a computer in there, or who the hell knows what's in there. So I'm going to say, well, what's in there? Oh, I bought a new computer. Okay, well, let's pull that out and treat that correctly. So, you know, but I think probably using tools like this to just present the information so the accountant doesn't have to think too much is probably good. But you do have to have somebody that at least knows something. I don't know, you're going to quiz them and say, you know, what form do writers' royalties belong on? I had a really famous writer. He actually passed away a short time after I started doing him. But the guy had been filing him in a completely wrong form for 20 years. You know, nobody ever caught it. It never made any difference. And it actually saved him money, but it still wasn't right. I mean, if he'd gotten audited, it would have been a problem, assuming somebody audited him that knew what the hell they were doing. But anyway, so that's that.
Well, let's go ahead and take some questions. We're a small enough group now that I think you guys can just unmute yourself and ask what you want to ask. And go ahead and ask whatever you want, but just do remember that I'm recording this. So don't ask anything so personal that, you know, that you don't want to share it with people outside this group.
Peter, what is your website?
Well, my one for the arts is artstaxinfo.com. And it's actually on the handout there, but yeah, it's artstaxinfo.com is the one specifically for the arts, and then I have one for the firm, but that's the one you want to go to.
Okay, thank you.
And that's got to write up on the S corporation. It's got to write up on Trump's tax bill, which was, hate to ever say anything good about him, but it was extremely good bill for a lot of writers. People saved a lot of money. So, but there's information on that, the checklist, etc. So there's a lot of stuff on there, and there's a lot of I try to have tools that people, you know, I'm not trying to get people to use me at this point anyway, but they're tools that you could use and present and give to an accountant. And again, you've got this copy of this tax return, which give you a really good idea of what it would probably look like when it's done.
And I have a question about Social Security. I'm not there yet, but we're starting to think about it. And how do royalties affect Social Security? Can you?
Well, they're going to affect Social Security because you know, if you're filing a joint return and your income is above, right, 44,000, then your Social Security is becomes taxable income. So up to 85% of your Social Security can be taxed. In fact, really, I tell most people if they've done even a remotely decent job of preparing for retirement, and especially if they're still working, that they're going to end up paying tax on 85% of their Social Security. And that's if you retire at retirement age. Obviously, you retire early, then you can lose your Social Security if you earn too much. This royalties would be earned income in that regard. So if you were retiring early and you were going to have 100,000 of royalty income, I mean, depending on what expenses there were, you would end up losing a bunch of that Social Security, or basically having to pay it back the next year. So it is earned income as far as calculation of Social Security would be concerned.
And so could you just not ever start up Social Security and just hold
Well, that's a whole discussion.
Yeah.
You never, unless you really have to, you never take Social Security early. Unless you really have to. If you can delay after 67, each year you delay through 70, your Social Security earnings go up 8% per year. It's significant if you can wait. So I think generally I feel like if you can wait, you do. And the other thing I'll add about that is that when I say wait, you get the additional benefit each month you wait. So I always remind people, I said, when I say wait till 70, I don't mean you actually have to wait till 70. I just mean that every month you delay after your retirement age, you're getting that bump up in those earnings. And if you look at it in a reverse way, and think of how much you would have to save to guarantee an 8% return for the rest of your life. If you think about it in that reverse, it's extraordinary. How much would you have to put away to guarantee an 8% return? About $100,000, over $100,000. And so when you think about it in that way, it becomes really significant. And Social Security is an annuity, and we all have it. So you're just trying to make the best of it.
Okay, thank you.
Yeah. Anything else, anybody? All right.
Okay, it doesn't look like it. So Peter, before we close, can you talk to us a little bit about what you do? Are you taking new clients right now? And how can people who want to work with you connect with you if you are taking new clients?
Well, you've got my email, and you can give my email out. I do still take people in the arts. I don't take anybody else anymore. On a regular website, I've got fees and whatnot, but I'm happy to field questions or something that comes up with somebody. Just tell me you were part of this group. But most of my vast majority of the clients I've gotten over the last 4 or 5 years are all over the country, and most people I don't ever get a chance to meet. So we're doing it via phone and email and that sort of stuff, and people scan stuff and send it to me and whatnot. So nothing's dependent upon anybody coming through the door much anymore. So I still have obviously a lot of legacy clients locally, but yeah. So people upload stuff, and so that's really mostly how we work now, is all electronically like that. But again, I'm happy to field questions if you have them, even later on. I'm not going anywhere, so I'll be here.
Awesome. Thank you so much. Well, I will make sure I'm going to be sending out a follow-up email probably tomorrow for those of you who are on the call. So I'll make sure that Peter's contact info gets put in there too, then, if that's okay with you, Peter.
Yeah, absolutely.
People can have a personal follow-up.
Yeah.
So thank you guys so much for coming. Thank you, Peter, for sharing all of this information. This is really, really helpful. And, you know,
Well, nobody fell asleep, so that's good. You guys get, you know, I can put gold stars on your forehead for that. Anyway, let me know if anything comes up that you want to ask me later.
Will do. Thank you so much. Have a
Thank
great
you
night,
all.
everybody.
All right.
Very helpful.
All right.
Okay, good night.
Bye-bye.